Hi, good day. My name is Elfreda, Jonker. I'm the Client Portfolio Manager at Alphinity Investment Management. Today I have Andrew Martin with me, one of our co-founders and also Portfolio Manager in the domestic team, as well as our financials analyst. So Andrew, as a starting point, let's talk about banks. Our position in banks last year was one of the big reasons why we did really well from a performance point of view. Let's fast forward to 2025, and they've all recently done another update. Can you tell us what were your major sort of broader thoughts around them?
Sure, Alfreda. Yeah, I mean, look, I guess the main thing over the last 12, 18 months really has been just not losing alpha on being underweight the banks. I wouldn't want to say that we were massively overweight the banks. We did make good stock selection alpha out of the banks that we had. I guess, and the main thing, to put it in context about the results that we're going to speak about, was the main differentiator really through last year and into this year has been earnings upgrades.
Yep.
The banks have been one of the few sectors, a couple of other financial sectors, but really one of the few sectors across the market that continues to get earnings upgrades all the way through last year, and therefore, despite valuation concerns, continues to outperform when pretty much nothing else was getting earnings upgrades. Yes. So that was a differentiator. So the big question going into this year has been what's happening to earnings.
Yes.
And if we look at the first quarter of this year, I guess earnings upgrades of banks have sort of flattened off and sputtered a little bit as people have been concerned around things like margins. So if we're coming into these recent updates from three of the majors had full results. CBA had a quarterly update, and the answer was not a lot changed. Probably slight net downgrades. Two of the banks a little bit more than the others. CBA, if anything, was slightly up again, but the net of it was slightly down. So again, no big cliff, no big massive change. The themes were all as what we've seen recently, which is margins have stopped going up, they're coming off slightly, but again, no cliff. Costs actually look pretty good, and then very good credit losses, so bad and doubtful debts. And that's been a big driver of earnings upgrades over the last few years, because the banks have large, very conservative provisions on their balance sheet, and therefore they can smooth those credit losses. At the same time, the Australian economy has actually turned out pretty good relatively, and therefore we're not seeing these big credit issues in the economy. By and large, companies have decent cash on their balance sheets. By and large, the consumer has adjusted their spending patterns to higher interest rates, for example, and so we're just not seeing those big losses come through. Things are off the floor, so it's not as if there's nothing. There are an increase in arrears, but it's off a very low base. And so just to wrap that up, there wasn't a lot that changed, but clearly we're getting towards the end of that upgrade cycle. The market now sort of understands where earnings are, understands the flexibility of conservatives and the balance sheets of banks and what they can do from an earnings perspective, and that's just meaning that things are flattening off to coming off slightly. So that does then create a bit of a potentially different outlook through this year, as long as we start to see some change in earnings elsewhere in the market. And that, we can speak about that, but that ultimately is the question mark.
And we can't really speak to clients without hearing the question, what's going on with CBA, and why is it so expensive, and why is it just continuing to go up? What are your thoughts specifically on CBA here? Yeah,
look, I mean, CBA is expensive. There's no sort of cutting it either way. When people talk about banks being expensive, but what they really mean when you delve down to it is that CBA is very expensive, and it's continued to get more expensive. And the differentiator again is earnings. It like the other banks has had earnings upgrades, but it's done even better. And into this year, while other banks are flattening off, if not coming off slightly, CBA has continued to have upgrades. So it is differentiating from that perspective. Look, there are flow arguments. It is a very large proportion of our index at the moment. It's the biggest bank, and therefore is attracting flows because of that, whether they be passive flows or people just covering underweights because it's such a large position, and the liquidity. We are definitely seeing, particularly with what's happening in the US, flows out of the US into other parts of the world. Australia's attracting those flows. and when it comes here, typically it's going into large liquid companies, CBAs, one of those. So I think it's a combination of things. Underlying is still that earnings census looks pretty attractive, but it's being pushed along by a few flow arguments as well.
Thank you very much, Andrew. For more information from Andrew and the team, please visit us on alphinity.com.au. Thank you.
Thank you.